Good morning, everyone, and thank you for joining today's webinar. After 3 rate cuts, the income landscape is shifting quickly. Investors are looking for places where yield can still work. Today's webinar is designed to help answer that. We're going to cover 3 parts of the income space: preferreds on the equity income side, muni bonds as a source of tax-exempt yield and stability, and finally, investment-grade corporates where dispersion is creating real opportunity. At the end, we'll answer your questions, so please submit them to Q&A at the bottom of your screen. The first segment we're going to start with is equity income, and I will pass it to Product Manager Coulter Regal to kick us off.
Great, thank you for the introduction, Kendall. Appreciate it. And yeah, we've been having a lot of conversations with our clients here over the last several months that we've seen the onset of interest rate cuts kind of reemerge as a trend and a topic. And many of our clients and investors have sort of been able to take advantage of the higher rates through things like treasury bills. And as the rates come down, more and more are looking to expand that income search beyond just simple treasuries. And so today we hopefully will be able to provide you a couple of options in vehicles to be able to earn additional income on and add within your portfolio. So to begin, we'll kind of discuss our option and our vehicle that provides access to the preferred securities market. The preferreds market is one that really is an interesting one that can provide a nice yield pickup and it has some attractive features as well. But our product specifically, the preferred securities X financials ETF, and we'll get into why potentially excluding preferreds or financials within the preferred space makes sense. We believe provides competitive yields that are comparable almost to high yield bonds. By excluding financials, there's a couple of advantages that we'll discuss in some of the following slides, including offering higher yield and more than just the broad preferred space itself. And if you can move events to the next slide. Yep. So just to kind of touch why preferreds make sense and why many are looking to them as an option to sort of enhance yield within their income sleeve of the portfolio. I think first and foremost is yield is obviously. If you look at the preferred space, they provide yield 6-7%, and that really is kind of on par historically with with high yield corporate debt. And so you're getting very attractive levels of income from this preferred space. And then there's a few other sort of advantageous qualities as well. I think one really that kind of lends to the name preferreds is that they have preferred priority when it comes to things like dividends over common shares of stock. And they sit sort of in a unique spot in the capital stack, above common equity, but below sort of your traditional corporate debt. And so they have a little bit of an advanced priority when it comes to liquidation of claims and income from these various companies. Another interesting area or I guess characteristic of the preferreds asset class is that many of these preferred securities actually have cumulative distributions. What that means is that in the event that there is perhaps missed distribution or dividend payment, that missed distribution will be cumulative in the sense that before the company can pay out distributions to any other say common shareholders, they first must pay those back pay those missed distributions to the preferred security holders first. So there's some priority there as well, preference. And then of course, I think one thing that many people don't quite realize when it comes to preferred space is that many of these preferred securities actually have some upside potential. So not only are you getting a very attractive level of income from the fixed coupons and dividends of these preferred securities, but many of them also have convertibility in terms of be able to convert to the underlying common shares of the company. So in the event that there is strong appreciation in the underlying common shares of the company, many of these preferred securities have the optionality to actually convert and participate in some of that appreciation. And then lastly is there are some favorable tax treatments as it relates to preferred securities. Many of them do pay dividends and qualified dividend income as well, so that would provide sort of an enhanced after-tax yield profile relative to many corporate debt securities. If you go ahead and advance one more slide, I think this slide really kind of just helps highlight the reason why many looked at the preferreds market in the first place. This chart shows sort of various yields across the market. Sort of the light teal color would be sort of the broad the income you would expect to receive from a broad basket of preferred securities that encompasses the whole universe of secured preferred stocks. And you can see to the right that really is quite comparable to high yield corporate debt. And so that's why many people when they look at this space, they kind of equivalent preferred securities to sort of the high yield corporate debt market, because you are getting income that is very similar to that. But I would also note that one interesting aspect of the market is you're getting yield similar to high yield, but if you actually dig through some of the credit ratings of the preferred asset class, there is a decent segment of the market that is actually, investment grade. So you're getting some portion of the preferred market that is investment grade, but you're also getting yields that are very similar to sort of high yield, bonds themselves. So a little bit of a, sort of a credit pickup there, if you will. If you go ahead and move it to the next slide for me. But there's one main issue that I think many investors don't quite realize when it comes to the preferred securities market, and that is, and if you see here, the pie chart at the bottom left illustrates this, that the vast majority of the broad segment of the preferred universe is actually issued by financial corporations, primarily banks and insurance companies and other financial service companies, but really it's the banking segment that is the predominant issuer of preferred securities. And there's been a lot of discussion over the last year or two, I think just broadly speaking about equity markets in general, with the Mag 7 and sort of large cap tech really sort of having a growing, share, making up a growing share of the equity markets in general. And you see some similar types of concentration and perhaps even more exacerbated levels of concentration within the preferred market, and that being financial issuers. And so if you move ahead to the next slide for me, Drew, by excluding those financial issuers, you're really sort of providing a couple of extra enhancements here. First and foremost, you're getting extra diversification as it comes to a sector profile. You're getting much more allocation to stable utilities, things like real estate, technology. Really, you're getting a much broader exposure set to the various sectors of the economy, rather than 50-60% or even beyond to just the financials market. But I think more importantly, you also get a little bit of a yield pickup. Historically, the non-financial segment of the preferreds market has provided about, call it 75 basis points on average, typically, of a yield pickup over the broad preferreds market, and that's just simply a fact of the issues, the preferreds issued by banks and other financial. They tend to come with a slightly lower coupon or dividend payment. So we've really seen quite an attractive return profile as a whole. You can go ahead to the next slide for me, Drew. And so that enhanced yield pickup that you get from the non-financial segment over time accumulates, and that carry will make a rather notable difference to your total return profile. And so this chart helps illustrate that. So the table at the top is simply just trailing returns year to date 1, 3, 5, 10. Of the first row would be the X Financials Preferred Index that our product tracks, and below that is a representation of another index that is a broad preferred index. So this would be an index that includes a higher portion of weight to the financial issuers. And you can see pretty much every time period here, you're seeing a nice total return pickup, and a lot of that does represent sort of the extra yield that you're earning that accumulates over time. And you can see down below the various calendar years, by and large, for the most part, we've done pretty well competitively versus the broad preferreds market. So by excluding those financials, you're getting diversification, a little bit of extra yield pickup that accumulates over time, and ultimately results in a very attractive total return profile. And so our product, PFXF, we do just that. This is a passive benchmark product, so we're not, there's no active management here. We're not picking and choosing. We're providing broad exposure to the preferred securities market that excludes financials specifically. And we've been in the market for quite a while. We've launched since in 2012, so we've got a nice long track record of a decade plus. And really, there's quite attractive levels of income. So I think currently we're about 6.5% in the SEC yield. If you look back historically over the last 12 months, we're about 8% yield total. And so just an option out there for many investors who either do or don't have exposure within the portfolio already to preferreds. If you do a slice of that within PFXF to sort of help reduce some of that concentration risk to the financial sector, as well as bringing a little bit of a yield enhancement to your portfolios, is perhaps an option that is worth considering. And with that, Drew, I'll turn over to my colleague Drew Anderson to touch on some municipal bond strategies.
Great, appreciate it, Coulter. So yeah, I just want to take a few minutes to kind of walk through where we're seeing sort of the strongest opportunities in the municipal bond market today, and how these different parts of the muni landscape can play very different roles in an income portfolio. So just looking at a high level here, I think there's 3 areas that really stand out. So attractive high yield spreads, improving income potential, especially for the leveraged muni strategies as rates move lower, and then strong after-tax yields in the long duration munis. So to sort of set the stage here, just talking about what the muni market is looking like in terms of issuance. So this chart here is going back to 2018 in regards to municipal bond issuance. And you can see here, 2025 was a record year, all-time high. That's not even over yet. I think we broke that in mid-November. So yeah, we're looking to eclipse or get very close to 600 billion this year, and even last year was a record. So I just think with heavy supply, especially kind of in that long maturity range, you're pushing yields higher and creating more of an attractive entry point for investors. And I think it's just important to note that this isn't necessarily a sign of market stress. I think it's reflecting a healthy market where issuers are refinancing, they're funding new projects. And it's right now it's helping keep valuations attractive. And we're seeing this especially in the high yield muni space. And especially in 2025, where spreads have widened modestly, even while fundamentally, even though these credit spreads are widening, the still fundamentals remain solid. So kind of looking at this chart here, we can see where spreads are today. So short high yield munis have really grown. Credit spreads have widened from a little under 150 bips to over 250 bips. That's a 100 bip spread expansion there. High yield as well, 40 bip expansion. And then just comparing this to AA munis. So it really pays to look into the high yield sector. And I think too is what we're seeing here, that this isn't necessarily this is more of a technical widening rather than like any sort of weakening fundamentals or additional credit risk. So we're seeing this mostly because of the more supplies, right? So more supply, issuers are having to offer wider spreads so they can clear deals. And this just means better compensation for those taking this selective credit exposure. And so spreads are kind of one part of the story, right? And the rate environment is the other. And this is where sort of our leveraged muni income has been taking a real advantage of the lower rates. And so this is just kind of an overview chart. We're showing muni closed-end funds versus just the Fed funds rate. Just a total performance versus what the Fed's fund rate's at. So very simply, inverse relationship, right? So when borrowing costs are low, muni closed-end funds tend to perform well. High, they don't tend to perform as well. And specifically, these closed-end funds hold a significant exposure of long-term munis. And I think this tends to respond first and strongly to these rate cuts. And then also kind of want to talk about the dynamics that are in play within these closed-end funds, referring to the borrowing and the leverage that they take, which makes them very powerful once the borrowing costs do fall. So here I just have a simple kind of illustration here of what an unlevered fund would be. So this is no borrowing cost, a levered fund with low borrowing costs, and a levered fund with high borrowing costs. So let's say, in your unlevered fund, you have $100 worth of assets. There's no leverage, so you'd have a return, let's just say 5%, that's your total return, right? And now if you have a levered fund with low borrowing costs, so let's say you add, that $50 worth of leverage, so total managed assets are $150. Your return goes up to 7.5% before costs. Let's just say 1% of those net assets are referred to borrowing. So then you're getting a 6.5% total return. So definitely a benefit in terms of having that added leverage. However, if rates are higher and you have those high borrowing costs, in the same example, you see 7.5% return before cost, but your borrowing costs are about 3%. This is going to take a hit on your total return. So this is kind of what you see with these closed-end muni funds when rates are higher and lower. And with the recent rate cuts, they've been a significant beneficiary of this current rate environment, and we're tending to see this with this performance. And so the other sector I wanted to mention that's really kind of seen a performance boost with the rate cuts is long-term munis. And so here we just have a chart. This is just over the last 3 months, so encompassing This one we're flagging the two recent rate cuts, but obviously we had the rate cut last week as well. You can see long term, if you're comparing it to intermediate, short, AAA, broad, high yield, has tended to been the biggest beneficiary of these recent rate cuts. And so this is just a classic early cycle behavior. Longer maturities benefit when rates begin to fall. And you're combining this with just the valuation reset from the record issuance. I think long duration munis are in a strong spot for both kind of sort of the income and total return potential. So if we want to look beyond performance, long duration munis also stand out when you look at the after-tax income. So this chart here is just showing yield to maturity, comparing investment grade long munis versus high yield corporates, EM corporates, ag, corporate treasury, global high yield. And you can see when you take into the fact of the tax exemption, whether that's either 37% tax bracket or 24%, there's a significant boost, and you're seeing whether you're at kind of honestly either of those rates, they're very competitive yields. And keep in mind, these you're still getting the quality credit and the low credit risk of investment grade munis compared to, let's say, high yield corporates or that sort of thing. So I think the difference here is that munis are doing very well in this sort of landscape, and can be very competitive, especially when you're looking at the after tax basis. So overall, I think for the muni space, we're seeing, high yield spreads that compensate well. You have the leverage income structures that are benefiting directly from the rate cuts, and then the long duration play here is offering some of the stronger after tax yields in fixed income. So with that, I want to hand it over to Nico, and he's going to walk through some similar opportunities that are emerging in the corporate bond market.
Thanks, Drew. Yes, we can go to the next one. But yeah, so I'm going to be covering the VanEck Moody's Analytics IG Corporate Bond ETF, ticker MIG, and then the VanEck Moody's Analytics BBB Corporate Bond ETF, ticker MBBB. But let's start by understanding the main idea behind these two funds, right? So the investment grade corporate bond market, it's enormous. There's thousands and thousands of bonds, and not all bonds are going to be offering the same relative value. What's going to happen is that some of the bonds within the investment grade are going to be paying you a lot for the risk you're taking, while others are not going to be offering you enough, meaning that it's not worth buying them if you're not really getting compensated for the risk you're taking. These two funds are designed for that, to help investors focus on the bonds that offer actually better value. They're going to be using the Moody's Analytics credit model to identify such bonds, and we're going to call those bonds attractively valued bonds. So at the end of the day, the goal of these two funds in the investment grade space, or in just the BBB space, is very simple. We're going to be using a disciplined, data-driven process to find attractively valued bonds. And if you go to the next slide, what we're seeing today, and we've seen over almost every time we've looked at this, is that there's a big theme in the investment grade corporate bond market, that is price dispersion. As I mentioned before, bonds, even with the same rating, we can look at BBB, single A's, and so forth. Spreads are very different, and the bonds are going to be very, very different. Some, as I mentioned before, are going to be paying you a lot. As you can see, some of those blue dots are going to be paying you a lot for the risk they're taking, while others are not going to be offering you enough, or actually are going to be offering less than what the Moody's model is going to say. And for investors, that creates a very attractive opportunity, because when pricing is not consistent, we think that being selective and picking the right blue dots on this chart is going to help you capture attractive yield and spread levels without needing to take a lot of risk or have to go into the high yield space, right? So at the end of the day, MIG and MBBB are going to be looking at those mispriced areas in the space, and are going to be finding those bonds that should be paying you more versus what the market is saying, and not looking at bonds that are not paying you enough, right? If you go to the next chart, here's we're going to define what are attractively valued bonds are. So super high level, we're going to be comparing two things, right? The market spread, which is what the yield that the bond's paying, versus the fair value spread, which is simple, the Moody's Analytics output, right? When the fair value spread is higher than the market spread, we're going to call that, no, sorry, when the market spread is higher than the fair value spread, we're going to call that attractively valued, right? We're going to call that an alpha opportunity, meaning that the markets, they're going to converge to each other, right? Simple comparison. And if we go to the next slide, we're going to look at a couple examples, which I think is going to illustrate it very well. So in here, we have 4 bonds, similar rated, triple B minus, issue size about 1 billion bonds, and maturity between 3 to 5 years. Very simple bonds, very similar bonds, but they're actually going to be offering very different risk. Again, the fair value spread is going to tell us what a bond should be paying based on the fundamentals. Think of it as expected default, expected recovery, even equity pricing, and how similar bonds have been historically priced. The market spread is just what the market's paying. So when we compare that, and then the market spread is wider or higher than the fair value spread, as you see on the Charter Communications, the DT midstream or the SocGen bonds, that gap is actually representing potential of outperformance. Why? Because the market spread is going to tend to converge to the fair value spread. It also means that those bonds are actually overcompensating us. They're offering more reward for the risk we're taking. On the other side, we got bonds like the Baxter International, which is actually underpaying for the risk, right? The market is saying it's only about, let's say, 80 basis points, while the Moody's Analytics fair value spread is going to say, hey, these bonds should be actually paying, let's say, about 90, 95 basis points. At the end of the day, we're going to be comparing this universe with a very straightforward goal. Find those mispriced bonds where the compensation is higher. So what MIG and MBBB are going to be doing is looking at the entire universe and looking for those alpha opportunities where the market spread is higher than the fair value spreads. And what has had happened over the last 5 years? If you go into the next slide, Drew, we're going to see that when we bring all of this together, right? Understanding that the investment grade corporate bond market is massive and that there's actually pricing dispersion, very simple comparison of spreads, fair value, Moody's Analytics, variable versus what the market is actually paying, and the goal of finding those alpha opportunities or potential for outperformance, we can see the impact on the long term. 5-year returns here, we'll see that the attractively valued triple B corporates and the attractively valued IG corporates, which are the underlying indices of MBBB and MIG, have actually delivered very, very much stronger risk-adjusted returns than the investment grade corporate bond market or even the AG or the core bond indices, right? With this, we believe that this approach reiterates a very simple idea that valuation, even within the corporate bond market, is going to be a very powerful driver of returns. It's not just going to be about ratings. It's not going to be about duration. Valuations is also going to help drive returns. And then last, awesome. So in this case, we're just going to kind of wrap it all up and summarize what these two funds do. One, they're using Moody's Analytics, which is a forward-looking data-driven approach that is going to be measuring the actual risk of each individual bond within the investment grade space and is going to compare it to what the market is pricing. This process is going to be selecting the bonds that offer the best value versus there's risk, meaning they're going to offer potential opportunities for outperformance. And it's also going to help us to steer away from bonds that may appear attractive, but are not really compensating you enough for the risk. In today's market, where spreads are very tight and pricing is still very uneven, we still think that this disciplined valuation focused approach is going to help capture yield. And it's not only about capturing high yield, it's about capturing smart yield. Especially in the investment grade space, you want to be looking at yield that makes sense given the risk you're taking and not just buy anything that's higher yielding. We'll leave it there. And I think there's a couple of questions. Coulter.
Yep.
I think
Hey,
you got
yeah,
a couple.
yeah. There's a few questions coming in, so appreciate that. But please do feel free to continue to input your questions down at the bottom of the Q&A section, and we'll do our best to get to all of them. If not, then we'll have folks who can follow up with you if that's preferred. But I'll start off here. I've got one where it's asking within the preferred space. Let's see here. He's noticed that a large portion of the preferred space seems to not have any credit rating assigned at all to sort of the individual issues. And so he's wondering why that might be and if that's any sort of indication about the creditworthiness of the company. And that's actually a very good question, because it is, if you do look across the broad spectrum of the preferred stock universe, there are a large portion of preferreds that do not have any credit rating at all. So they simply just show up as not rated. And that's largely a function of the fact that credit ratings are not a requirement for any of these issues. In fact, typically, don't realize this, but in order to have a credit rating assigned to an issue like a preferred security, it's actually at the cost of that particular company. They've got to go out to one of the major credit rating agencies like Moody's or S&P, and you essentially pay them fees for the evaluation of their credit, as well as ongoing monitoring of that security, for any updates to the credit rating. So many companies, the preferred securities aren't necessarily their primary form of capital raise. They do oftentimes have traditional corporate debt, which will have credit ratings assigned to themselves. So for preferred securities, it's not uncommon for many companies to just simply choose to not pay those fees to have a credit rating assigned and assessed for their individual preferred securities, simply for the fact that A, they have perhaps credit ratings assigned already to some of the more corporate or senior debt, and then B, is just simply that the end market, the investors of the preferred securities, just might not necessarily demand it. When it comes to more traditional debt, corporate debt, higher up, senior, oftentimes credit rating is a very significant factor in the decision that investors choose. But it comes to preferreds, they're a little bit less picky. And I think Boeing, for example, is a great example of this. So Boeing, there's our top holding within our fund, BFXF. They have a preferred security, and Boeing is themselves an investment grade company, but this specific a preferred security they chose not to have rated, so it shows up as non-rated. But it doesn't necessarily mean that the company or that preferred security is any sort of indication of potential risk to default. Obviously, default is always a scenario that you should consider, but it's really largely more of a function of just these companies choosing not to pay to have those securities rated.
Great. I also just want a quick touch on too, regarding the closed-end funds and just how the rate cycle, the current rate cycle has been aiding to them. So, I mean, first we talked about how they're long duration, the lower borrowing costs, I think is key. But I think just two other things quickly is that you'll notice, obviously with closed-end funds, you sort of have that discount to NAV that typically narrows, and so you'll kind of see a total return benefit there with the closing of discounts, as well as just look, you're not getting as much yield in money markets and that sort of thing. So I think people, take that cash and they're looking where can you invest this with similar credit risk, and so munis tend to be a great avenue for that. So I think just want to note that as well.
I saw someone ask about what bonds are a good deal now, and how often does this indices or these ETFs rebalance, at least MIG and MBBB. First of all, these ETFs rebalance on a monthly basis, and the fair value spread is calculated on a daily basis by Moody's Analytics. What bonds are a good deal now? I would say it kind of depends, but if you look at both ETFs, you're going to see what bonds were a good deal on their previous month end, and you can see at least the returns versus the broad indices over the last few years have been actually pretty decent. But I'll make sure that take a look at the website and make sure at the holdings of each funds, they change on a daily basis, but at least the composition of the indices and of the underlying ETFs are going to change on a monthly basis.
And let's see, I've got another question coming in on preferreds, asking about duration and rate sensitivity, which is a great question as it relates to the preferreds market. When you think of a traditional bond, they typically have a maturity date, whether that's 10, 15 years out or shorter, varying lengths of maturity. But as it relates to preferred securities, oftentimes many of the much of the preferred market is actually perpetual, meaning that there is no stated maturity date. And what that means ultimately is that the duration on some of these preferred securities can be quite long, essentially in perpetuity. But But in practice, what that actually means is, when a bond or a security is perpetual, oftentimes there's no maturity date, but there are embedded call options or convertibility features. And so, historically, when you look at sort of the aggregate preferred space in terms of sort of the modified duration or the effective duration, which includes sort of the embedded optionality of calls and converts within the preferred space, typically you have a duration of about call it 8 to 9. It can be as low as 7 as well. It can kind of vary a little bit across the market. But in reality, I think ultimately what I'm saying is that, there can be some level of, interest rate risk and duration as it relates to the preferred securities market, which is, relatively common in sort of the fixed income space. So just know that there, many of these preferreds, can have long data maturities. And ultimately there can be some amount of duration risk, associated with that.
Great. And it looks like one question in regards to the munis. So within the muni space, to what extent is there tax regulatory risk associated with the asset class? And if so, to what extent are investors compensated for it? So we haven't really seen, there hasn't been, in terms of new laws and that sort of thing, munis are still tax exempt federally. So we're not necessarily seeing any changes there or expecting any changes anytime soon with that. Obviously, nothing's for certain, but we're not necessarily seeing any changes to that. So I'd say ultimately it's pretty low risk, but I think in general, I think today's elevated yields would suggest that investors are still being well compensated, for the risk and yeah, so I'd probably just leave it there. Yeah. All right. Well, I guess, if we don't have any other questions, I just want to appreciate you guys taking the time to join us today. If you're interested in more VanEck content, you can feel free to check us out at vaneck.com. So just thank you and have a great rest of your day.